Hi, I'm Curtis Hill, a certified financial planner with Serenity Wealth Management. People make stock market investments knowing three things can happen. The stock market can go up, the stock market can go down, or the stock market can go sideways. And obviously, they're most interested in the stock market going up because that's where they make their money. But if you look back in time, and in my book, The Wealth Conspiracy, I talk about during the first 2 decades of this century, the stock market was actually dropping or recovering from a decline 78% of the time. It makes new highs, but most of the time it's dropping or recovering. So it's hard to get to your money when you might need it. This is particularly important in investing. Most people investing in the market are looking for the market to go up, and they're making what we call single directional investment. Single directional meaning they only make money when the market goes up. They lose it when it goes down and sideways. They're used to this. This is why most people just compare their investment with the S&P 500. But let's look at the market and see if maybe there's some other ways to get to what I call multi-directional investing. All right? Let's look at the market over the long run. It does something like this. So what people are trying to do when they invest for the long run, they're trying to predict what's going to happen, let's say over a year or two. So they predict a company's direction based on their earnings projections. They think the stock is going to go up, so they think since the earnings will go up, the stock price will go up. There's a little bit of a problem with that because there's more and more a disconnect between individual stocks and what their earnings are. But if we look at a more broader and safer way of investing, where we invest through indexes only, like the S&P 500 or the NASDAQ, you don't have individual stock risk. You have a broader. And now let's just try to predict what that's going to do. A lot of people do index investing. They're just trying to invest what's going to happen and assume the market's going to go up over a certain period of time. But again, it's single directional. Little less risk because it's broader. But now, what if we could fine-tune this better? What if we had the intelligence and the computer skills and the AI skills that we could project not what's going to happen over the next year, but what's going to happen over the next few days? So you can say, okay, the market's been falling for 3 or 4 days. It's oversold. Let's think the market may turn around from this oversold condition and go back up. So we look right here and invest for the market to go up. Well, we don't look for it to go up all the way to here. We just look for a short-term rise. Now, if the market's hit a high point, we can say, maybe this market is overpurchased, overbought, and there's going to be selling pressure to take profits. So what may then happen is the market will drop. And you can also invest on an inverse basis. There's mutual funds that you can buy in that are opposite the market. You could buy inverse S&P 500 that makes money when the market goes down. In other words, if the market goes down 1%, the inverse S&P 500 will go up 1%. So you can actually make money in both directions. Isn't that different? And it means that even in a market that just goes sideways for a long time, just goes like this, you can get in to these little ups and downs and make money even in a sideways moving market. Wow, now we've gone from making money in only one direction to now we can make it in two. And more importantly, we can make more money when we take advantage of these little ups that we have. All these ups add up to more than the total movement from here to here if we have all of these little greens that we add that we're taking advantage of. Let's put a bunch of them in. They will get in and in and out, in and out, in and out. All those greens will add up to more than the total movement of the market. The point is, you got to do this in such a way that is so low cost of trading that it makes sense. And you don't want to be aggravated with having to make these trades. So you have to have computer automation that will come in and do this for you. And they have to do it so inexpensively. So you can use institutional mutual funds And there's some that allow you to get in and out the next day. So you can hold these, not intraday trades. These are things that will last for a day or two, a week, maybe 2 weeks, these little periods. So you can add all these up over the year, and you can make money in an up market, a sideways market, and even in a down market. Because even in a down market, you can make money because there's little upticks and little downticks that you can profit from the whole way. So now we change the equation. I said in the first 20 years of this decade, the market was only up 22% of the time. 78% of the time it was declining or recovering from a decline. Doing this, you can drastically increase your gains, plus highly limit your losses or eliminate your losses altogether. There's no guarantees because you're still trading the market. There's other things that would guarantee your safety on the downside. We can talk about that as well. But these are things that we'd like to sit down and talk to you about. How some of your money may be better in a trading program instead of the typical buy and hold programs that Wall Street teaches. Wall Street teaches buy and hold programs because they don't think retail can handle this. We disagree. We have the tools so that retail can handle this. And Wall Street reserves this to their customers that have, $10 million to invest. That's why you look at the Wall Street trading, and you look at the New York Stock Exchange, 75% of the trades are computer-generated trades. So let's talk about getting the retail guy, the small guy, into this stuff that works so good with the big guys. Thank you, and please like and subscribe if you'd like to hear more videos like this. Again, Curtis Hill with Serenity Wealth Management.